For more than 20 years, I've helped executives, entrepreneurs, engineers build 7 and 8-figure portfolios, but few of them saw it coming. It wasn't inflation or bad investments. It was something hidden in plain sight. Something they thought they were doing by the book that quietly chipped away at their income year after year. And by the time they realized what was happening, they'd already lost thousands of dollars when they didn't need to. If you're nearing retirement or already in it, you need to understand this, because once it starts, you may not be able to undo it. By the end of this video, you will know exactly what it is and the steps to manage against it in your retirement. You assume that taxes will go down in your retirement, but no one tells you that it may be the opposite. When you stop working, your paycheck stops, but your taxable income does not. You're still pulling money from 401ks, IRAs, Social Security, maybe you have rental income or a pension. All of that can push you into higher tax brackets without realizing it. You retire thinking, I'll take out $100,000 to live comfortably. But if you're pulling that money from income taxable accounts, you will owe anywhere probably between $10,000 and $20,000 in federal income taxes on that one withdrawal. That's before we talk about state taxes, Medicare premiums, or RMDs once you hit age 73. According to a study, retirees lose 4 to 6% of their portfolio annually to income taxes because of poor planning. Over 25 years, that could drain hundreds of thousands from your savings. It's not just about money, it's about managing taxes. When you pay money to taxes, you reduce your income and you may increase your healthcare costs. But the good news is that you can help manage this with a plan. Here's the part most people will never hear from their financial advisor. It is absolutely possible to earn $100,000 in retirement and pay no federal income tax. You don't need to hide your money or need a fancy tax shelter. All you need is a working knowledge of how the tax structure is written and how to structure your income in a way that the IRS rewards. This is exactly what I strive to do with my clients. When we build retirement income plans, we don't just focus on how much they're going to need to withdraw. We focus on how it's going to be taxed because that's where the biggest costs come from. The best part is you don't need a complicated financial strategy to make this work. In fact, you can do it using 3 simple principles. First, you want to use tax-efficient investment income sources. Secondly, you want to sequence your withdrawals strategically. And finally, you can blend tax-free and taxable accounts so that you pay as little as possible to the IRS. Once you see this in action, you'll learn that it's not just possible to live off or earn $100K tax-free in retirement, it's surprisingly straightforward. I'll show you the way to use this step by step. The first step is to use the tax code to your advantage. The US tax system is progressive, so that means the more you make, the more you pay, but only within each bracket. It's important to understand how money is categorized. Some income is fully taxable, some income is partially taxable, and some income is not taxed at all. Let's start with the standard deduction. In 2025, a married couple filing jointly gets a standard deduction of $29,200. That means your first $29,200 of income is not taxed at all. On top of that, the next chunk of income is taxed at just 10%. Then it goes up to 12% and so on. Long-term capital gains can be taxed at 0% if your income is low enough. And with smart planning, most or even all of your Social Security benefits can be tax-free too. If you keep your total income under a certain threshold, up to 85% of your benefits can be tax-free. So instead of earning $100,000 from sources that include all ordinary income, you could create a plan where a portion comes from a Roth IRA, a portion comes from Social Security that's not taxed, and a portion comes from capital gains that are taxed at a 0% tax rate. This is how the tax code is designed. It rewards people who spread their income across different types of accounts and use a mix of taxable, tax-deferred, and tax-free assets. The next step is to learn tax diversification. So consider 2 retirees, Sam and Clark. Both want to live off of $100,000 a year. Sam pulls all of that money from a traditional 401k, so it's taxed as regular income and he ends up paying thousands in taxes each year. But Clark splits his income like this: $30,000 from a Roth IRA, $25,000 from long-term capital gains, $20,000 from Social Security, and another $25,000 from his traditional IRA. The Roth IRA is tax-free. The capital gains tax might be taxed at 0% if he held the position for a year and a day. And also his Social Security may mostly be tax-free as well. Also, because their taxable income is lower, the $25,000 that's coming from the traditional IRA will be potentially taxed at a lower tax bracket. So the Clarks end up paying almost nothing on federal taxes, yet both of these scenarios, the people are living off of $100,000. Most people just pull from their IRA or their 401k without thinking about the impact, but that's not a smarter approach. Start with your taxable accounts, then add in your traditional and your 401k accounts to stay in a lower tax bracket. This way you avoid pushing yourself into higher tax territory and save tens or even hundreds of thousands of dollars over your retirement. Finally, the third step is to sequence your withdrawals, because what you withdraw is just as important as how much. Withdrawal sequencing is all about the order of what you take from different accounts. And most retirees don't think about this. They just pull from whichever account is easiest. But the wrong order can push you into a higher tax bracket fast. This is the strategy that works for most people. So an early retirement before age 73 and you have to take your minimum required distributions, you want to take your money from your taxable accounts first, and maybe even a little bit from a Roth. This keeps your taxable income low and allows your traditional IRA and 401k to continue on growing and compounding in the background. And as a plus, also allows you to do Roth conversions as well. Now, once you hit RMD age, you're going to want to change gears. So your RMDs are going to force you to have to take out the requirement from your traditional IRA and your 401k accounts. So that's all taxable income. So if you do find yourself in the situation where you need more income, then you can tap into your brokerage accounts and maybe even at this point your Roth IRA to supplement your income so that it will help you stay at a lower tax bracket than if you were to take additional money out of your 401k. Here's how it works. The tax brackets are progressive. In 2025, the 12% tax bracket for married filing jointly goes up to $94,300 of taxable income. So for using this as an example, if you could structure your withdrawals to stay under this number, especially after subtracting the standard deduction, you can live on six figures and pay low taxes. For example, a couple with $100,000 income could have a taxable income under $71,000 after the standard deduction. That keeps them fully in the 12% bracket or below. Now, if $30,000 of that income is for a Roth IRA and another $20,000 is from long-term capital gains in a brokerage account, then their taxable income amount could drop even lower. Now let's talk about the extra moves that you can take to move your plan from good to near perfect. The first one is to do Roth conversions in your low income years. So let's say, for example, that you retire in your late 50s, 60s. This is a great time to start converting dollar amounts from pre-tax to Roth before you have to start taking Social Security and minimum required distributions. Now, you could decide how much you want to convert and what tax bracket you're comfortable with staying in, but the beauty of doing Roth conversions is that they're going to help to lower your potential RMDs in the future, and also it gets your money more time so it can start compounding now tax-free. Secondly, you want to use qualified dividends and long-term capital gains smartly. So if you're married filing jointly and your income is below $94,050, then you could potentially pay 0% on these sources of income. That means that you could have $100,000 in income coming in and $30,000 of that coming from long-term capital gains. And for that long-term capital gains portion, you could potentially pay 0%. The next move is to have a health savings account. So if you've built one up during your working years, then you want to use those dollars for qualified medical expenses during your retirement. Withdrawals for your medical costs are tax-free, and after age 65, normal withdrawals are just treated like your traditional IRA. But for most people, medical spending and retirement is high enough that those withdrawals are just coming out tax-free. Also, you should, if you are charitable, take advantage of making charitable distributions. So if you're over 70, you could actually contribute directly from your IRA to a charity. And this is called a qualified charitable distribution. This will count towards your RMD and is not counted as income. So if you're already charitable and you don't need that RMD every year, then you can use all or some of your money that you're making as a charitable donation and not have to pay any income taxes on it. Now, these moves might not sound flashy, but they do work if you have a plan. According to the Tax Foundation, over 61% of US households pay no federal taxes over a given year. With the right strategy, you can actually be one of them, because it's not about beating the system, it's about using the system in the way that it was built. So the real win isn't just saving money on taxes, it's the confidence in knowing that you're not wasting what you've built. When you structure your income right, you're not living smaller but smarter. You get to keep more of your money and extend the life of your retirement savings. Everyone wants to retire with $100,000 a year in income, paying almost nothing in taxes and still sleeping well at night because you know it's all legal. That's possible if you understand how the system works and use it the way that it was meant to be used. Many people think that tax planning is just for the rich, but this strategy actually works best for people who are middle income, people who save steadily and want to have a good retirement without handing over more than they have to. It's not about being sneaky, but about being smart. Once you've seen how it works, you're never going to look at taxes the same way again, and you can enjoy your income. Now you've seen how paying zero on retirement income of $100,000 is possible with intentional planning. Many retirees never hear this because they're stuck reacting to tax bills instead of designing their plan around them. But you don't have to be one of them. The real power is using the system the way that it was built, choosing where your income comes from, timing your withdrawals, and balancing your accounts. These aren't just tactics. They're your way to retire with more freedom and confidence. If you're serious about keeping more of what you've earned and creating a retirement plan that works for you and not just the IRS, then let's talk. I'm offering a complimentary strategy session where we're going to look at your income sources, run the numbers, and build a plan that aims to put you in the zero tax zone legally. Click the link below to schedule a one-on-one call. One conversation could save you thousands in taxes. Let's strive to make your retirement work on your terms.